Recording. Okay, target net income and margin of safety. Mohammed, share your screen, please. Right, very good. Yep, go down. Activities. Good, go down to TNI and MS. One more, down. Down. Hey? What are you talking about? Can't get any further? Right? Okay.
The children must be.
Oh, wait a minute. What? Is this unavailable?
No, no, it is.
Can you see this?
Yeah, I can see them must be.
Why not? Okay, try again, load again. Oh, you're on now, right? Open assignment, target net income, okay, great. Now, these are exercises and problems which you should know for Thursday. Now, Thursday would only be a half-hour quiz. There's only some theory questions, some calculations, some straightforward. All right, so let's start the assignment. Read the question. You can make, okay. First of all, now, simple calculations. Unit selling price, unit variable cost, contribution margin, and if you move over, Mohammed, you have the ratio. Right, so now, you have to get the contribution margin. Remember, the ratio is a percentage of sales. So what's the unit contribution margin here? Right? Selling price minus variable cost. 39. All right, now take it as a ratio. 39 as a percentage of selling price. 13%. Okay. Does everybody understand that? Two very valuable tools. The unit contribution margin and the unit contribution margin, or the unit contribution margin ratio. Now you get that on a unit basis, you get it on a total. In the second question, we're given the contribution margin, but we're not given the unit variable costs. So you know that sales minus variable cost equals the contribution margin. Work backwards and get the contribution margin. All right, now take the contribution margin as a percentage of sales. Always a percentage of sales. Okay, good. Now, unit sales, unit variable cost, we don't know, but we have the contribution margin and we have the percentage. So we can get the sales by dividing the unit contribution margin by the ratio. Okay. And that way we get the total sales. All right. Not 23,000, I don't think so. What did you do? It's the contribution margin. What's the contribution margin ratio?
10.
Move over 10.
Yeah.
Okay, divide by 0.10. It's, remember, it's a percentage. Okay. And therefore, the variable cost will be. Okay, let's check and see if you got it right. Very good, Mohammed. Any questions? You must know the relationship. It's so important. Contribution margin per unit, contribution margin per ratio.
The last one.
The last one, you take the contribution margin per unit, you know it's a percentage of something. What did they tell you the percentage was? 30%? So you take the contribution margin and you divide it by 0.3, 30%, to get the sales. That gives you the sales, and then you subtract and get the variable costs. How come you're way over on the screen here, Mohammed? Can you move a little bit more? Okay. Yeah. Okay. Wait a minute. No, I'll do it. Okay. Ah, okay, the problem was me, all right. Okay, Mohammed. Out loud, read the question, please. Mohammed,
Yes.
read the question out loud, please.
The traditional income statement for base company shows sales $900,000.
Right.
So $600,000. And operating expenses $200,000. Assuming all costs and expenses are 70% variable and 30% fixed. If there is
Okay. So when they gave you the cost of goods sold here, you know that those are fixed costs and variable costs. And when they give you the selling and admin, you know that they are fixed and variable. But for the CVP, we must break them into that portion which is variable and that portion which is fixed. If I know the variable, 70, I know the fixed, I'm sorry, the contribution margin is 30. Okay. So prepare the CVP statement. You've got the sales. Now the next thing is the variable cost. And that's the cost of goods sold times 70%. All right. All right, and the selling and admin times 70%. So know this format. We're going to go over a number of times, so you're very familiar with this tool called cost, volume, profit, and income statement. It's not a financial accounting income statement. So you total those, and what do you get? Should be here, right? Yeah. Total variable, 560. Then what is the next? Good. Contribution margin, very good. Contribution margin is the sales minus the variable cost. Now that's contribution towards the fixed cost. They didn't give us a fix, they told us that the fix is 30% of the cost of goods sold and 30% of that. But that's all they wanted was down to the contribution margins. Okay, very good. Any questions? All right, let's continue. Again, another statement. They give you the sales for the first quarter of 2020. So CVP income statement for the first quarter 2020. Again, sales, cost of goods sold, selling and admin, and selling separate. Good. Very good, Mohammed. You got a good understanding. Yep. So the variable cost, you total them, subtract from sales, get the contribution margin, and then calculate the total fixed costs. Any questions? Yes. What? Module 4. Okay. Okay, good. You got the contribution margin. Remember, sales minus variable costs. Now we subtract the fixed. So all the fixed given to you, simply put them in and total them up. Okay. Should be good. Very good. Very good. Gonna get through this real quick. Wait, slow down. Everybody else, go back, Mohammed. Everybody get a chance. Make sure you know that thing. Any questions? All right. Okay, move on then. 4. All right, and this one, 4 of 9. Melody Manufacturer produces a CD at 20. Contribution margin ratio is 40, fixed expense 900. So this will be like a quiz question. 4. You don't get the contribution margin, but in this case, you are they give you the contribution margin ratio, I'm sorry, 40%. So they want to know, compute the variable cost per unit. So the contribution margin is 40, the variable cost ratio is what? How many? Okay. If the contribution margin ratio is 40, the variable cost ratio is? Pardon?
Yes.
Yes.
Sales plus contribution margin. Then number we get the minus.
No, the contribution margin ratio is 40.
So then
The variable cost ratio is what? If the contribution margin ratio is 40, what is the variable cost ratio? Pardon?
60%.
60. It always has to add up to 100. The variable cost plus the contribution margin equals 100. So if you know the contribution margin ratio, you also know the complement is the variable cost. If they give you the variable cost ratio, the complement is the contribution margin. So here, you know, the variable cost ratio is 60, and they're simply asking us, what's the variable cost? 60% of what? Right, selling. So calculate that. Right, 12. All right, so now they want the now compute how many CDs they will have to sell to break even. Well, what's my formula for break even? Now, this is unit. They want to know the number of units, so I need the unit contribution margin. Well, if I know what the sales are, and I know what the variable costs are, what's the contribution margin?
Fixed cost divided by.
Yeah. 8. So divide the fixed cost by 8, and you get the number of units to break even. 1,150? Okay, try that. Now, not only do they want to break even, they want to determine how many units, calculate how many CD units do I have to sell to give me a profit of 16.5. So you take the target net income and you add it to the fixed costs. And because they want the answer in units, you divide through by the contribution margin per unit. So the answer is 3,175. You added the fixed cost to that. Okay, any questions? Everybody got that?
The first one.
You have sold for 20, contribution margin ratio is 40, so the variable cost is 60. So if the selling price is 20, the variable cost ratio is 60, you multiply that. Variable cost. 20 times variable cost ratio, which is 60. Right. Okay. You got 12. That's all I want. What's the variable cost per unit? 12. Get that? And you have a question as to okay. All right. Now, the next one is break even. What's the formula for break even? Don't go so commanded, it should be on your memory. Okay, yours is 20 and yours cost ratio is 60. No. If the variable cost ratio is 40, if the contribution margin ratio is 40, the variable cost is 60. 60 and 40 add up to 100, okay? Now, wait a minute, we're still waiting. Back, yeah. Any questions? So to get the break even, you take the fixed cost divided by the contribution margin per unit, but you don't have a contribution margin per unit yet. But you have sales of 20 and you have variable cost of 12. So your contribution margin per unit is 8. So you divide 8 into the fixed cost to get the number of units you need to break even. Then the question says, we want to earn a profit. Well, whatever that profit they want to earn, you simply add it to the fixed costs. And they want to know how many units they have to sell to earn that profit. So when you hear units, you divide through by the contribution margin per unit. If they say sales dollars or required sales, you multiply by the contribution margin ratio. Okay, go on there, Mohammed. All right, in this question, Orleo Company makes computer bags that sell for 20 each. In the coming year, management expects the fixed costs to be $230,010. And the variable costs are $14 per unit. So if the sales is 20 and the variable costs are 14, what's the contribution margin? 6, right. And therefore, the break even is simply, and they want it in, no, they want it in dollars. So now you have to take 6 as a percentage of 20 and you get what? More than 30%. 6 divided by 20. Six divided by 20 is what? Right. 0.3. Right. And you divide that into your right, fixed costs, and you get $766,700 is your break even in sales. Good. So they want now to compute the break even in sales using the contribution margin ratio. What do I mean by that? Compute break even in sales using the contribution margin ratio. You just did that. Same thing, so put it down there. Okay, let's see what they're doing. What do they want here? Right. Now, compute margin of safety. Assuming the actual sales are 942,500. So the margin of safety, and they want the ratio. The margin of safety is the difference between what I'm selling now, 900, and what I need to break even, which is 766. So I subtract those two. I get the margin of safety, but they want the ratio. So now I take the margin of safety as a percentage of sales. And I don't know what that sales is. Okay, there's my margin of safety, 175.8. Now I got to go up and figure out what my sales are. So move back up. Okay, the sales for the coming year, management expects the fixed cost to be 230 and variable cost to be that. So if the sales then is 700, is break even 200. All right. Sales are $20 a bag, and how much is the sales at break even? Well, total sales at break even is contribution margin divided by the contribution margin ratio. So I got the contribution margin, 6, divided by, well, it's 20 times the number of bags. And I don't know the number of bags, so I have to go back and figure out what's the number of bags. So I take 230,000 divided by 6 to give me the number of bags. Okay? 230,000, not 10, 230, oh yeah, 10. Divided by 6 gives me 38,335 bags. Now I sell each one for $20, so my total sales are 20 times that. No. Huh? No, my total sales were the number of bags times 20. What did you get that? 766? No. Mohammed, how many bags do I need to sell to break even? I mean, what's my total sales?
7667.
At break even, what's my total sales? Oh, I'm sorry. Oh, okay, I don't need that. Excuse me, I'm sorry. I have the total sales, so go down. You took the margin of safety, now take it as a percentage of 942,500. We don't need to calculate that. I'm sorry, my mistake.
Can you say actually sales?
Okay, the margin of safety is the difference between 942,500 and what I need to break even, 766. So what is that?
Actually sales.
You have the same numbers?
Actually sales.
Actual sales minus break even. Right. Right. How much? Okay, for you. All right. What do you get? 13%, 19%. Okay, that's the margin of safety. How you did it is you take this, which is your sales, minus what you need to break even, that's your margin of safety in dollars, and divide by the sales. 942,500. Okay? Well, that's, okay. Number 6. Again. Ericsson makes student book bags that sell for 20. Come year, management expects it to be 225, and the variable cost per unit is 14. All right, so do the break even again. We just have the same, and they want the break even sales in dollars, so you need the contribution margin ratio. So again, that is 0.3. Divided by the fixed cost divided by 0.3. And you get, what's that? 225 divided by 0.3. Divided by 0.3. What's, okay, 750. All right. Good. Go down. What is the contribution margin ratio? We need to, using the contribution margin ratio. So now we need to break even. Divided by 0.3, same thing. Yeah. Good. Now, again, the margin of safety. Is that what they're asking you for? Contribution margin ratio, assuming the sales are 937. So there's your sales. And your break even in sales is 750. You take the difference, you get the margin of safety, and you divide that by the sales. And you get 20%. Okay, very good. Slow down there. Wait, so everybody else get caught up. Any questions? That's the same as the one before. On margin of safety. Okay, Mohammed, number 7. Oh, no, there's another part to this, yeah. Compute the sales required to earn you a profit of 150. So now, you got your contribution margin ratio, 0.3. You got your fixed costs, and now you have your target net income. So now you add the target net income to the fixed cost and divide through by the contribution margin ratio. And you come up with the required sales. Okay, Mohammed, what's your fixed cost? Go back up, what's your fixed cost? Okay, fixed cost 225. What's your profit that you want to obtain? Add that, 155. Add the 2 right there with the calculator, okay? Go back to the calculator. Okay, now you've got 375. Now you divide through by the contribution margin ratio. And the contribution margin, not the margin of safety ratio, 0.3. And you get 1,250,000. Try that. Okay. Same. Good. Any questions? Anybody want to slow down? Raise your hand if you need some help. All right, number 7. Ivanhoe Manufacturers has a net income of 104,000 during 2021. The company wants to earn a net income of 44,000 more during 2022. The company's fixed overhead is this, and the variable cost ratio is 30%. So if the variable cost ratio is 30, what is the contribution margin ratio? 7. Right. So now, total the target net income, the net income they had last year, plus what they want this year. All right, now add that to the fixed costs. Okay, now divide by the contribution margin ratio. All right, try that. Okay. Good. All right, let's move down. What do they want now? They say, okay, that's your required sales. Now prove it. So put in the sales. All right, now, what is the variable cost ratio? 30. So what's the total variable cost? Good. You can subtract those two, or you can take the contribution margin ratio of 70 and take it as a percentage of sales. All right. And subtract your fixed. Your fixed has remained the same. $9.7. All right. And there's the profit, which was 104 plus 44, which is 148,000. So you've proven that at that level of sales, you will earn a profit of 148,000, which is your target net income, which is 44,000 more than it was last year. Okay? All right. Now, in this question, we have the following. We did this one the other day. You're given the costs, sales price per unit, variable cost per unit, fixed cost in total, variable selling 10% of sales price, variable admin 2 per unit, selling price and fixed selling expense and fixed admin. And you're asked now to do an income statement. All right. Contribution margin income statement for 2022. All right, so we start off with sales. Now it's given to us on a unit basis, and they tell us that they sold 117,000 units. Sales. Okay. Now variable costs. Variable cost, 117,000 units, and the variable cost is $33 per unit. Okay, so there we have. Now, variable selling is 10% of selling price. Okay, so therefore I have to do is take 10% of total sales. Minus 643. And then variable admin is 2 per unit. So that would be 117,000 times 2. Add them up, and you have your total variable costs. Now, subtract that, and you get your contribution margin. Okay, and now you take care of your fixed costs. They're easy, they're full total amounts, so yeah. Fixed cost of goods sold, 666. All right. And then, all right. Very good. Okay, wait there for a minute, let everybody else. Are there any questions? Make sure you bring a calculator and a piece of paper. Okay? All right, down below it says compute the break even. Oh. Break even sales in units. So I need the fixed costs and I need the contribution margin per unit. I have the fixed costs here. 1,400,700. I need the contribution margin per unit. And I divide by that's the ratio. What's the selling price? They give it to us? Yeah, they gave it a selling price 55. So 55 minus 33 minus 5.5, which is 10% of the selling price, minus 2 gives me the contribution margin. I'll do that. Selling price 55 minus the variable cost. Okay, minus 33 minus 5.5, which is 10% of the selling, minus 2. There's my contribution margin per unit. $14.5. You don't need the ratio. So now divide the fixed costs, which you have calculated down below, by 14.5. And break even, you say, would be 96,600. Very good. Any questions? All right, now we want to know the margin of safety in dollars. Okay, so the margin of safety is what I'm selling minus what I need to break even in dollars. So now you need the ratio. You have to figure out the contribution margin ratio to get the break even in sales. Sales dollars, that is. All right. Very good. There it is, 5,000,003. So you took the number of units, multiplied by 55, that's fine. So therefore, that's the sales at break even. What are they selling now? Go up and see what they're selling now. No, put down. Put down. Right there, sales. They're selling 643. No, 6,435,000. So subtract 6,135,000 from your break even in sales, which was 5 million. And you had 1,122,000. Now that's your margin of safety in dollars. Okay, that's all I want. I didn't want the ratio yet. Very good. Is that it? Is it? Yeah, that's it. If they ask you for the ratio, then you would take that amount of dollars and divide it by the sales. Okay, hold it there for a while. Any questions? Okay. Number 9. It's almost the same thing again. Do it one more time. And $2 per unit. Okay, you have your total variable cost. Now you can get your contribution margin. Good. Now subtract your fixed costs. That gives you the total fixed. Now the difference is your net income. Good. Now they want to break even in units. So you need the contribution margin per unit and you need the fixed costs. The contribution margin per unit is selling price minus variable cost of goods sold, minus the 10% of selling price, minus the $2 per unit. 15. So that's your contribution margin per unit. And if you go down, you have your fixed costs. And there you have enough to calculate the break even. Okay. 90,000 units. Good. Okay. Now they want the margin of safety. So I need to break even in sales dollars. So you can get that by taking the contribution margin of sale. Or you could just take the 90,000 units of break even times the selling price. So that will give you the total sales. That will give you the sales at break even, sorry. And the total sales was 500,000, right? It's 5 million. Total sales was 5 million, so therefore 500,000 is your margin of safety. And that's all I wanted was their margin of safety in dollars. Very good.